So I hosted our first quarter economic and market outlook last week. And one of the questions I got during that webinar was, we always hear that markets don't like uncertainty. Yet things are so uncertain right now, yet the markets, if you look at the S&P 500, they continue to rip higher. They continue to see all these record highs. So what gives? Do markets still care about uncertainty? And my answer was they do, but if we just acknowledge the fact that things are always uncertain, we're never going to have a time when we just have total clarity, total certainty. I think what makes things so tough right now is the instability, the fact that we still have uncertainty, but things seem to be changing every single day. We're always wondering what's that next headline to come out, whether it's news and the continuing developments around Iran, around Greenland. Last week, we saw the threat of 100% tariffs on China after news came out that they were moving towards a deal with China on trade. So things are just very unpredictable right now. There's a lot of news, a lot of things that are really just fluid. And I think that can be very disorienting for equity investors. But if you're waiting for a time when there is total certainty, you're going to be waiting quite a while. If we look at investor sentiment, I think it's really interesting. We see the investor sentiment is actually the highest that it's been since 2021. And that might surprise a lot of people, but it's consistent with the fact that the growth outlook continues to be strong. We've seen that equity markets continue to rip higher, as I said before. But if you compare the current investor sentiment to where it's been, say, in 2021, following the blue wave in the elections, or going back to 2017, shortly after the Tax Cuts and Jobs Act was passed, what's different now is that we don't have, we still have a lot of downside risks. And so I point this out because it does mean that at current valuations, with current elevated investor sentiment, we are vulnerable to some downside surprises. I think that's really important, especially this week when we're going to receive a lot of information. For one thing, we're waiting for some major earning announcements this week. Actually, this week, there's over 100 companies in the S&P 500 that are scheduled to report earnings. So that's about 20% of the index constituents, but these companies account for about a third of the market value of the S&P 500. These companies include Microsoft, Meta or Facebook, Apple, and Tesla. So these are going to be really interesting announcements. They're going to tell us a lot about where the AI trade is heading next. And we know that these are some of the companies that have really run in recent years. And so the expectations are quite high. The bar is high for these companies to continue providing these really positive announcements about the future of the AI trade. Next up, we have the Fed meeting. So they're meeting tomorrow, Tuesday, and Wednesday. They're not expected to cut rates at this meeting. So far, the inflation data, the labor market, it's been cooperating with them. They can afford to pause here. So we don't expect them to cut. I think it's going to be really interesting, as always, to hear what Fed Chair Jerome Powell says in the press conference that follows the conclusion of their meeting. He will likely receive questions about the recent subpoena and investigation from the Department of Justice on the Fed and on Jerome Powell. He'll hear a lot of questions about Fed independence, but we'll see where all that goes. If we stay on the topic of the Fed, that the other thing I would mention is that we're all waiting to hear who will be nominated as the next Fed chair to replace Jerome Powell. Now, historically, these nominations have come when the incumbent Fed chair has about 100 days left in his term, and we're right about there with Fed Chair Jerome Powell. His term expires in May, so we're right around that time when we should be hearing about who President Trump has in mind to replace him. That will be very important as we start to think about the future of monetary policy. And then finally, the other thing that we're keeping an eye on is January 31st and a potential government shutdown. Yes, we just had one late last year. I hope we can avoid it this time around. But right now, if you just look at betting markets, the odds have jumped to about 80% in terms of chances for another government shutdown. So Look, the news flow is not going to stop. It's our job to keep an eye on it. And what we say is, look, just stay the course. It's really hard to ignore the headlines and to kind of fight that myopic view. But it's so important to keep that long-term discipline. If you have any questions, please reach out to your financial advisor. For us, we'll continue to watch the data. That's what's important. Where's our economy going? How are these companies doing? And how does that inform our view going forward for the market and how best to position portfolios? So it is so important to distinguish between what is actually noise and what is signal. What is newsworthy and should have an impact on how we approach portfolio management. So I'll leave it there for now. I'll plan on seeing you again next week. As I said, if you have any questions, please don't hesitate to reach out to your financial advisor.